Okay, let's go ahead and get started. Tried to save all the juicy stuff for the end, kind of wake everybody up and get everybody reinvigorated. So I'm hopeful, I'm actually sure, not just hopeful, that that's going to actually transpire up here. The format here is each of the speakers will talk for 15 to 20 minutes, and then we'll have a moderated discussion following that for about 20 to 30 minutes, and then of course we'll meet outside for some adult refreshments if you're willing to stay. But with that, what I want to do is introduce the moderator, Michael Levy. He's at the Council of Foreign Relations. He actually is the director of the Program on Energy Security and Climate Change, and he's the David M. Rubenstein Senior Fellow for Energy and Environment. He has also recently published a book, which he's been out and about publicizing a little bit. I actually caught him on Bloomberg when I was in Australia about 2 weeks ago, and thought that was pretty cool. He did a great job. So, Michael, I'll pass it over to you.
Thanks, Ken. I never quite did the calculation to figure out what time it was in Australia when you caught me on TV. I know it was extremely early in New York. So I'm really delighted to be able to moderate this panel for a couple of reasons. The first is that it's an extraordinary time to be thinking about the geopolitics of energy. It's hard to find a time in recent history where there's so many big changes happening in so many parts of the world, whether it's demand in Asia or disruption in the Middle East or the growth in US supplies. I could go on to a host of different data points. Putting these pieces together is extraordinarily challenging. The other reason that I'm excited about this is because there are few places that are able to bring together markets and geopolitics well. There's a world where people are very smart about markets and then make grand claims about geopolitics on the basis of very little. And there's another world where people talk about geopolitics and they feel compelled because of what's happening in energy to speak about the consequences of developments in energy markets, even if they're not quite sure what's really going on there. And the Baker Institute and the center here are just fantastic at bringing these two pieces together. It's something close to my heart. It's part of what I've tried to do in this book that Ken mentioned, to bring together different pieces of the puzzle. And so I'm excited to hear from all of our panelists and to have a discussion with them about how these different components come together. We'll have three speakers. Amy Jaffe is well known, I'm sure to all of you here, is now the Executive Director for Energy and Sustainability at the University of California at Davis. She'll be speaking about the oil price cycle and geopolitics, dire implications for OPEC. There's a question mark on that. Charles McConnell, a former Assistant Secretary for Oil and Gas at the U.S. Department of Energy, will be speaking about U.S. energy policy and its impact on energy markets. And then Greg Priddy, a director at the Eurasia Group, will be speaking about Asian energy security and post-peak oil geopolitics. So Amy, over to you.
Great. Well, this is a great panel because everybody's sort of looking at the same thing from a different geographic and policy perspective. So I'm going to talk a little bit about the sort of geopolitical catalysts and then sort of the touchy-feely anecdote stuff that goes behind some of Mahmoud's wavelet analysis. But I think the important thing to think about, and what I found so interesting when he was doing the wavelet analysis, is that, as we were discussing in the last session, there's definitely a cycle, and the cycle definitely has patterns and trend lines, but, in the end, you have these catalysts that come from the geopolitical arena and really either accentuate the part of the curve that you're in or maybe disrupt you off the pathway for a particular time. And, of course, those are the things that are so hard to predict. But they're also the things that are, quite interesting and take a lot of analysis. And so I have this picture that I like to use at the beginning of my talk. Some of the people from Chevron and others have seen this picture over and over again. But basically, what I like to do, sometimes what I do is I don't have the title on the picture. And then I ask you to guess which countries it is in each picture. And nobody guesses the right side correctly because, of course, that's Saudi Arabia and Qatif in 2013, right? And that brings up this question. There's this presumption somehow that, you know, we had this Arab Spring, and it affected the countries like Egypt and Tunisia, and it's spreading to the Levant, Syria, and so forth, as Ambassador Regent discussed. And everybody makes it sound, when they talk about it, like it could never spread to the Persian Gulf. And that's really probably not a correct assumption, given the fact that the political conditions and economic conditions that we would describe, the kinds of things that Ambassador Regent talked about at lunch, the strain of unemployment, the anger about corruption, the feeling that you want to get up in your day and know that no one you know is going to be whisked away by the secret police, right? That concern that so enlivened the population of Tunisia is also true in the Gulf. And maybe not in some of the very small countries in the Gulf, but definitely in the larger countries. And this is something that we have to think about. With all due respect to my last thing, and Mahmoud and I talking about the cycle is the cycle, and I really do think that the research really proves to where we might be in the curve. But on the other hand, you know, the outlook for whether these people in the streets could bring about an oil disruption, I think that there's a big question mark about how that's going to play out, and that remains sort of a backdrop to what happens in the oil market. So I have two sets of points to make here. One is this point, so I'll be very brief, which is, you know, what if the worst case happened? You know, what would be the outcome of a worst case scenario? Suppose tomorrow morning, you know, we wake up and it's not Turkey on TV. It's some major oil producing country. And you know, as I have in this other slide, the idea that oil field workers wouldn't go out on strike in the Gulf in a country, it's already happened. It happened in Oman. It disrupted their exports for several weeks. And Oman is not a key country that's having unrest. So it could happen. And we don't know exactly how it might happen. It could happen through a war or some kind of miscalculation. But it could also happen just simply by, you know, oil workers not waking up in the morning and not going to work. It could be the use of chemical weapons escalates in Syria and spreads to countries that are funding the opposition. It could be a cyber attack, as we all saw last summer, right? So we don't know exactly how these kinds of things could come about and what country it might be. But let me just make the obvious point, which is there's no replacement for Saudi exports. So if it happens in another country, we might be able to get the Saudis to replace those exports. But if it happens in Saudi Arabia, there's no replacements. So, you know, somebody asked me one day, well, what would happen if the thing that the thing that went offline was Saudi exports? And, you know, so I just chunked down a few things for people to think about that black swan. Reversal in economic recovery, I think, would be instantaneous. The possibility that the financial and banking crisis that might go along with that could be worse than the last one could be high, because it's going to disrupt all the sovereign wealth funds from the Middle East, and they're the ones who bailed out the Europeans in the first place, right? So if you suddenly have a loose ball, like who's in control of the sovereign wealth funds in the Gulf because of some horrible event that would happen in Saudi Arabia, you know, that also means that the banking situation could be even worse next time. Bet on alternative fuels. You know, I like natural gas and transportation if suddenly I can't have oil from Saudi Arabia because it's available and everybody can convert their car for $300, right? So the second I would see that something's going down in Saudi Arabia, I would run out and buy clean energy stock, right? So other things. Take on board the millennial trends. You know, the VMT for millennials is falling dramatically. People want to live this urban lifestyle. It's a sort of a walking, living, local, community choice aggregation, distributed energy, telecommuting lifestyle. And if they couldn't get fuel, they would be happy living in that lifestyle, and the rest of us would have to live in that lifestyle too. Right? And then the other, I think, obvious point was, which we were just discussing in the last session, you know, if I knew that I had a market for it instantly, every brother with $1 would be investing in an MLP for shale. Right? And so the U.S. supply response, I think, under this scenario would be huge. and then unclear what it would be down the road and what kinds of things would fall out from that. But I think that would be sort of an instantaneous response. So, here's my usual talk and Ken's talk about how, what's different. We used to think that the oil was going to be far away and we needed lots of distribution infrastructure, giant tankers, giant pipelines. Now all of a sudden, the oil and gas is actually where the lights are on. It's right next to end user demand. How is that going to change geopolitics, barring this major catalytic event of a war in the Middle East? What would it mean? So if we don't have a war in the Middle East that is really disruptive to infrastructure, and that's, I think, one of the interesting things about Mahmoud's wavelet analysis is that it shows you that just having a guy change who's the emir or who's the king, might not necessarily be so dramatic in its immediate impact in terms of oil production and existing infrastructure. So it's only if the infrastructure gets destroyed. So, what do we know? We know we're at a record high deployment of capital, that 30% of that is coming to the United States. WoodMac is projecting $80 billion by 2015 to come into North America, into the shale. That's quadruple what it was in 2010. New pipelines, refinery tower upgrades, all of that is going to change transport patterns and export economics, right? And I think after we see the Panama Canal expansion in 2015, again, there's a lot of product that might not necessarily be 100% commercial to move out today that's suddenly going to be really commercial to plug a hole in supply in Asia or compete against traditional naphtha or LPGs or something like that, some of those products in Asia. Just a little map of where, this is Deutsche Bank's projections for tight oil. Every time I give a talk and I pick a different person's map, I put higher numbers. It keeps going higher and higher numbers. Every time I have to give a talk every 3 or 4 months, I change my map and put higher numbers on it. So I do think the trend line is up. I'm not sure I agree with the city that the trend line is up to 10 million barrels a day at some point, but I think this 3 million barrel a day number that we all originally said is going to look really achievable. Right, and the question is how much farther beyond that does it go? And then, so just briefly, let me make a comment. The great thing about this chart for me and Ken and Mahmoud is it was kind of like an ink blot. We all looked at this chart and we saw 3 different things. Ken saw the really big impact of the QE2 and QE3 on the price of oil. Mahmoud looked at the chart and said, oh, the curves don't fit. The long-term trend is not clear, right? And I, as a layperson, looked at that chart, and this is what I took from it. Do we have did the pointer work? This is working? I looked at this, and I said to myself, clearly, since the hump here was clearly sloping, and then lasted a long time, right? I felt like I looked at this and I thought, okay, this here is clearly like something like this. And we're on the other side of the hump. That's what I saw when I looked at this, right? So my feeling is, this is instructive. We're on the other side of the peak, in my opinion. I mean, barring a war. Right, so that's what I saw when I looked at the 2 things together. So it's interesting. We all 3 saw something different, and I guess time will tell, or maybe they're all right. But here, I think, is like a very telling thing that sort of re-summarizes in a non-wavelet way what Mahmoud was saying. Okay, blue line is non-OPEC, red line's OPEC. Right? And this is not different than the 1980s. And the thing that I think is so interesting when you go back and pull out historical news articles is that this line, some of which is tight oil, came about because of these MLPs, and everybody's grandmothers invested in an MLP. And if you go back and read about 1980 North Sea, they had all these trusts where people, Lord Byron and all these other people, are throwing their money into trusts that we're going to use to finance North Sea production. and North Sea production went up dramatically between 80 and 84 in a way that was not expected. You know, the growth was just so much larger than people expected. And then the decline, which eventually happened, didn't happen for the much longer time than people originally thought, right? So, you know, to me, the North Sea story is just repeating now, and OPEC has this choice, right? Which they already see. At the last OPEC meeting, you saw all the ministers disagreeing. Do they defend prices or market share? And Allah Yamani from the 1980s, you know, as he told King Fahd, you can't do both. You have to pick one or the other. Which one are they going to pick, right? So, so my feeling is if they pick price, they're swimming upstream for a number of reasons. Number one, you know, I mean, here's the vehicle miles traveled statistics for the United States. You know, and some of this is the recession, but some of it's generational and also lifestyle choices, right? And then, you know, and what does that translate into? You know, here's the U.S. monthly oil demand a line, right? Just the, you know, the straight line unadjusted, right? So to me, if you add to those trends, and you know, I think Mahmoud showed the oil intensity line, which was also some giant line down, the relationship between, you know, oil intensity and GDP. I mean, all the indicators are these long structural downward lines, right? And if you're the United States and you're in a, say we have a business as usual world, and you're seeing all these long-term structural decline lines that give you the option to export material. We're already exporting refined product. I guess we're going to export LNG in a year and a half, right? The United States has this incredibly unique opportunity with these exports. And I would add to that, you know, propane and natural gasoline and probably soon condensate, right? As the Canadians are talking about doing their own light oil, tight oil, and then they won't need the condensate from the United States, so that's going to have to go somewhere. It's going to have to go to Asia, right? The interesting thing about this is if all this material is going to leave the United States and be approved to leave the United States at a spot market related Henry Hub /WTI /ICE price, then the price leadership of transparent market prices becomes a double pressure on OPEC, not just the volume of natural gas substituting for oil in Asia, not just the volume of condensate coming into the markets or LPGs coming into the markets to Asia to compete with the Middle East barrels, but the pricing. That the pricing is going to be 100% spot, it's going to be 100% transparent, and it's going to be market adjusting. And then how in the world, if you're Russia or you're Qatar or you're OPEC, are you going to be able to impose a fixed upward-leaning price tied to commodities that are not market reflective? I just think that the momentum from the United States, from a policy point of view, one of the big arguments, in my opinion, for exports is just the world that the United States wants, which is a market competitive world for energy, where the top, you know, supplies of energy win because the most cost-effective things come to market to the most cost-effective places to use them, that world is the U.S. export world. So that's my thought. Okay.
Excellent. Thank you, Amy. And set a very good precedent on both making things interesting and sticking within the time. Charles.
I don't have any PowerPoints. I have a few thoughts I'd like to share with you and maybe spur some conversation. When Ken first asked me to speak about U.S. energy policy, I did get to breathe a sigh of relief. Before resigning from the Department of Energy, I would have had a completely different story for you today, but I can speak as a private citizen today, and I'm glad of that. You know, there's a kind of a joke that goes around. We don't have an energy policy in this country. You hear that ever? You hear it all the time, actually. And I guess I'd argue with you kind of along the same lines as, have you ever been to an art museum and looked at something on the wall and said, that's not art. It might not suit your taste, it may not be exactly what you like to look at, but it's art. And I think that's the issue that people struggle with energy, U.S. energy policy is, well, does it make sense? Is it doing the right things for business markets, for our country, for global competitiveness? I think your actions and what you do speak loudly about your strategy and your policy. And whether or not you articulate it that way, it is what it is. I think imagining a future, your words and your thoughts and the politics that are behind them certainly, but let me give you a couple of examples about actions or maybe inactions as I give these remarks and the tactics that go along with it. You know, the Department of Energy during this whole sequestration period actually is having, the administration's actually proposing an increase for the budget. But as part of the Department of Energy, the fossil energy budget is going to get a 25% reduction as part of sequestration. Those are actions. Those are tactics. I think it speaks loudly to strategy. Tactics and strategy drive the business framework that you're in. The marketplace reacts to it, and then, of course, investment flows or it doesn't flow. And truthfully, from all the years of being involved in business, the biggest single detriment to investment is uncertainty. And uncertainty, whether it's real or imagined, and we've seen a lot of the conversation today about that, you know, it creates an underlying concern for people that are investing about what the future is going to be like and whether or not it will impact the security of the investment. And from a U.S. standpoint, the security that we have from an energy standpoint, and maybe more importantly, long-term global competitiveness. And whether we're taking the steps today to ensure that that's going to be part of our future. I've heard it said a million times, and you probably have as well. This shale gale has created an incredible opportunity for the United States that if we don't screw it up, we're going to have advantage for the next 20, 30, 40 years. That's probably true. But there's a lot of things that go into that, and that's a lot of what frames the politics. Talking a little bit about oil and oil prices and federal policy, you know, we've had a lot of enthusiasm in our country about how much domestic oil we've produced and how much has come up over the past several years. And we're all happy to take credit for that, but how much of that is really due to federal policy? I would argue not much. And good news, bad news, it's a fact, I believe. But I think what it does speak to is states that are taking specific policies forward in the areas where they can take advantage of them are the things that are creating U.S. energy policy in the tactics that those states are moving forward. North Dakota is a great example. You know, it's the second largest McDonald's in the world is in the Bakken in North Dakota. Did you know that? Yeah. It's amazing what's happened to that state. Do you know the state of Mississippi has increased its royalty revenues from $7 million a year to over $150 million a year from oil that's being produced in the state of Mississippi? They've taken the amount of domestic oil that they've produced from enhanced oil recovery from 5% of their total capacity to over 50% of their capacity in the past 4 years, specifically because they've put policies and tactics in place to incentivize enhanced oil recovery. Those are the kinds of things that you're beginning to see pieces occurring. And I won't suggest it's not part of a grand U.S. energy strategy, but it is very much part of regional energy strategies, state energy strategies that are moving forward. We see that here in Texas as well. You know, some things have changed too, I think, while all of this is going on. World I lived in most of my life in business, commodity traders were all about figuring out how to take advantage of shortage. I could argue today good commodity people have a paradigm shift. How do you take advantage of abundance? Where do you make investments in real assets? There's different questions. Risk in oil. Years ago, it was all about E&P risk. And I would argue in many places around the country, whether it's the Bakken or up in the oil sands or a lot of these places where unconventional is going on, the oil's there. We all know it's there. I don't know if it's $12 in the oil sands anymore, Amy, but I will say for sure that the costs are really what's driving it in those areas. And costs have changed. They change a lot. But it's more of an engineering and execution issue than it is an E&P issue anymore. It's a different game today than it used to be. And certainly from a technology standpoint, transformational technology has really played a big impact. Let me give you an example of 4 areas that over the past couple of years we've seen U.S. energy policy at work or not at work through no action, but it's the policy, okay? Example of the regulations for the EPA for coal-fired power plants and whether they're new builds or potentially retrofits on existing facilities. And whether or not the regulations are clear and whether or not utilities can invest, and truthfully, the clarity isn't there. And as well at the same time, the economics for natural gas have changed dramatically as well. But I don't think you can find a utility in this country that's planning on building a coal-fired power plant these days. Now, some could argue that's a good thing. Others would argue that that's a shame that they're in such a purgatory position. But that's a policy that's in place, and it's definitely causing an effect. And you can roll that into the same conversation while we're talking about coal-fired power plants. The fossil fuel budget for carbon capture and sequestration technology development is down 40% from where it was 4 years ago, while we're streaming forward with an all-of-the-above strategy. I don't know. It doesn't sound like that to me, but that's part of what's going on. That's driving natural gas. It's driving natural gas implementation, and that's great. But everybody in the industry, in the industrial power industry, knows that natural gas will not get a hall pass on carbon dioxide either. It's not been expressed. It's not for sure, but it's out there. And carbon capture and sequestration long term for CO2 removal from natural gas facilities also going to be necessary in the future. Keystone Pipeline. That thing's been around for a while. Lots of conversations about, is it a good thing? Is it a bad thing? You know, the study that the State Department was involved in began last April, and it was determined that it should be a 9-month or 12-month study or something like that to get it into this year, because it was important to study all the ramifications of that pipeline. And at the end of the day, the study came back and said it's not going to be environmentally detrimental. It's not going to have those kind of draconian effects. But still, we wait for an approval. And the recent news that came out is that Canada may not be looking at going to their west coast with it, and what does that do? And so this inaction, this not deciding, continues to keep investments in U.S. refineries on hold. And I could argue pipeline decisions from the Bakken to the East Coast for East Coast refineries are also just as much in kind of an unknown circumstance right now, because the clearances for those pipelines will have to go through. All of that says over time the U.S. can exploit those sources of energy. You could argue it's domestic or certainly North American-based energy, and it's all good and it's all part of our long-term strategy, but still those investments remain locked up because of the uncertainty. LNG permitting. Those studies have gone on certainly long enough. I believe Ken was actually testifying a year or so ago about the impacts of the LNG regulations and the LNG permitting. And it's a pretty obvious fact that the amount of LNG that would be exported would not materially change the cost of natural gas for natural gas utilization in this country. It's certainly a good thing for jobs, investments, et cetera. And I think the policy that we have right now really isn't a policy at the Department of Energy, if you really dig into it. The preponderance of evidence in the LNG permit process is such that if you can't demonstrate that it would be a negative, then it should be approved and moved forward. And of course, the next step would be to go to FERC and move forward. But even with all that and the fact that it's a rather straightforward recipe anyway, we continue to have this delay and the uncertainty that comes with it. And I think, again, that goes back to the investments. And will we be exporting in 18 months? Now, some of those facilities may take 3, 4, 5 years for the changes to be made, for the financing to get in place. All of that's part of our long-term ability to create those jobs, move that resource. Again, it goes back to being able to execute based on a sound understanding of what's going on. And then finally, fracking. What's the federal policy on fracking? Well, in fact, if you look at it hard across the country, it's really the primacy of the states that are doing the work, or the states that are capable with their own technology capability of defining what business as usual and good operating practices are. It's really not so much a federal issue unless the states ask the feds to come in. And there's some uncertainty around that as well. Some states like Texas and Oklahoma, I would suggest, probably would just as soon never see a Fed. And there are other states that have welcomed the feds in and made good use of it. Michigan is a great example. And then there's other states that are, for whatever reasons, they're deciding that they probably don't want to decide anything. And so they're going to have a temporary ban on fracking. All of this leads to a rather uncertain circumstance. And if you think about it, when Shell makes an announcement that they'd like to build a world-scale ethylene cracker in Beaver, Pennsylvania, because of the Marcellus Shale, and all of the enthusiasm that comes from that, jobs, creation. I'm from that area, and trust me, Beaver could use a plant that hires people, okay? There's still a reluctance to put the capital in the ground, because what will be the requirements associated with that, and will the fracking regulations change? Could they change? Could the government step in? I guess my takeaway message is all of this requires clarity. And sometimes this idea that stepping in and making a decision, although sometimes not politically expedient, really is the only thing that business is screaming for, is some certainty. Thanks.
Thank you, Charles. Greg.
Yes, isn't working.
He should maybe use the cursor buttons.
Oh, you've got the buttons here. Thanks. No, it isn't.
That happens to me all the time. I don't use them anymore.
I just use the buttons. So when you're talking about Asian energy security through the lens of the North American shale boom, which of course is having transformational effects worldwide, this is of course a very broad topic to cover in 20 minutes, but I'm going to try to leave time for the Q&A and stick to that timeline. This first graph here illustrates, if you had drawn this 2 years ago, it would look a lot different. And if you had drawn it 4 years ago, it would look radically different. But just the amount of additional supply coming on from the U.S., this is all based on the IEA forecast. And I think if anything over this time period, it might, the U.S. might surprise on the upside a little bit. But, you've got 6 million barrels a day coming on between 2012 and 2018. U.S. tight oil growing by 2.3 million barrels a day. Again, that might surprise on the upside. This is the IEA numbers. And then annual non-OPEC supply growth averaging roughly 1 million barrels a day, or almost 2% annually. So that's really having a transformative effect on the world market. And this next graph is kind of the shift in, this is based on the IEA medium-term forecasts, but the shift in the conventional wisdom on where we were heading in terms of the call on OPEC. And this becomes, a very important structural point, not because OPEC is really credible as a cartel or, that they're actually going to come together and offset this, but, the fact that there's going to be a crowding out impact as some OPEC producers increase their capacity, and other, it's actually a crowding out impact as the Saudis end up having to cut as others increase. And you can see that, in the most recent IEA medium-term forecast, the call on OPEC is actually continuing to come down through 2015 and only recovering slightly by 2018. I think if I were going to draw this line, I would draw it slightly lower than that. But it's definitely a market where, you have a well-supplied world market because of the non-OPEC developments and increasing pressure on OPEC. Coming to kind of a big picture view of what this does, in terms of Asian supplies and energy security and trade flows. The U.S., some people talk about a hemispheric market, and I think that is a little bit of a misnomer in that one of the interesting trends here is the amount of, light sweet that the Atlantic Basin no longer needs and that's going to be flowing out of there. So it's not really fair to call it a hemispheric market, but you have a market where North America is gradually backing out imports. The pace of that is accelerating. And then you end up with, by 2018, 2020, you probably still have the U.S. as a net importer, but you end up with most of that coming from this hemisphere. The one asterisk to that is the Saudis, I think, are going to do what they need to make sure that they are still a substantial supplier to the U.S. That there is definitely a political impetus for that. But you're going to have a U.S. market that is overwhelmingly supplied from North America and within the Western Hemisphere. And then from China, you have kind of an opposite picture where Chinese liquids production is probably not going to increase very much. Still growing, while we think that demand growth there is going to moderate even in relation to GDP growth, that relationship seems to be gradually shifting. In a presentation this brief, I don't have time to break out all the reasons for that. But you have China being supplied more and more by unstable parts of the world, and not a whole lot that they can do about it. So you look at the imports. This graph on the right is 2008 versus 2012. Huge increase from Saudi Arabia, more coming from Angola, Iran, which is coming down. Oman has been a big supplier for a long time, and then also other Persian Gulf countries, most notably Iraq, where you have a big Chinese role, both in terms of the China-Iraq political relationship and also the field redevelopment contracts. But you essentially have China having to be a free rider on the American security presence in the Gulf, and also kind of an awkward situation in which China would like to have good relations with everyone in the Gulf, but in an environment where there is an increasing polarization that's not just driven by all the headlines that we see about Syria and the Saudi-Iran tensions, but also by that coming crowding out effect, driven by a better supplied oil market. This graph just shows the forward curves on Brent and WTI as of about a week ago when this was made. I think I would be a little bit more bearish than this, but this shows that the market is pricing in, in terms of backwardation, what we call post-peak oil scenario, of increasing supply. I think slightly at a variance with the previous presenters. I probably, I'm not thoroughly convinced that we bust through the marginal barrel. So if you ask me where we are, 5 years out from now, but I'm not an economist, and I generally don't think on that long a time horizon. I'm a policy analyst, so we're looking at it, through the lens of how public policy is going to impact that. When you look at the kind of next 18 months to 2 years roughly, I think that you're going to see a continuing, you had a big Saudi reduction in output at the end of last year. Started before the OPEC meeting. OPEC had no headline change, was totally irrelevant. I think that trend will continue because I don't see any way that they come to any consensus on a new quota system. But even with sanctions on Iran having taken off nearly half of Iran's exports, roughly 1 million barrels a day knocked off of Iranian tanker loadings, you still had the need for the Saudis to pull back output, at the end of last year to offset what was going to be a very sharp slide in the call in OPEC in the first half of this year. I think before the end of this year, you're probably going to see them having to pull back below 9 million barrels a day. And then, in 2014 and 2015, you're still going to have supply capacity growth globally exceeding demand growth. And so you end up with them having to pull back, probably asking Kuwait and Abu Dhabi to take some of the burden there. But basically nobody else beyond perhaps, those two others helping with that volume. In the short term, again, like on a 2-year, perhaps 3-year time horizon, I think that the budget deficit that the Saudis might be in, if you have prices drifting lower as a result of the spare capacity build, it's probably still manageable. And I do think that they will restrain output in the near term. But out beyond that, it becomes much more of a question. Whether they can sustain that, whether they might try to go back to a market share strategy. And then, the other problem they have is that going back to a market share strategy, because of their internal spending needs, and we generally agree that the current budget balancing price is probably in the low 90s. Because of those spending needs, even if they did a modest amount of spending reduction, they can't deal with prices low enough for long enough, to kill off the higher cost barrels, and certainly not shale. And so this eventually leads to a pretty uncomfortable situation. Briefly on Iraq and Iran, because I need to break those out individually, those are really the two kind of medium-term wild cards. Iraq, we see their production continuing to grow this year. It probably grows next year. It's probably about 400,000 to 500,000 barrels a day of additional upside. But then we think it's probably going to plateau, about 18 months out from now, because they haven't put the water injection facility, they haven't gotten the contract awarded for the water injection facility, which is really key to going beyond about 4 million barrels a day. The other variable, of course, is the Kurdish issue. But because those things are not resolved rapidly enough, you probably get a plateau in Iraqi output of 2015 or so at around 4 million, pending the resolution of those issues. If the Iraqis were to resolve those and go above that, it becomes even more uncomfortable in the out years in terms of how much the Saudis would have to cut. And then Iran, there's the question of sanctions. I mean, most of the consensus forecasts are building in the assumption that they stay roughly at the current level. It's possible there could be a breakthrough on the nuclear issue, highly unlikely, but if that happened, that, essentially the sanctions have pushed back the day of reckoning for the producers and this crowding out effect by effectively increasing OPEC compliance and bringing them down closer to the OPEC 30 million barrel a day target without the Saudis having to do that entire volume. But on the other side, and more probable than a resolution, is that, that we might feel comfortable enough that we try to push sanctions farther and push the Asian importers to bring down those volumes, which again is a bit of an uncomfortable situation for China. I'm going to deal briefly with refining, and again, I'm trying to stick to my time limit here, so I'm not going to get into all the details of this, but Asia has been building out, much more sophisticated heavy conversion capacity. You've got China in particular, which a decade ago had been tied in very much to light sweet barrels. Has a much more sophisticated refining capacity right now. And this is essentially a bet on the light-heavy spread, but and it was done in the expectation that medium sour supply, from Saudi, Iran, and Russia would be growing growing along with the scarcity of light sweet. But the backing out of the light sweet from the United States from the shale boom is changing that equation somewhat, which moving forward, is going to have an impact as some of those barrels from the Atlantic Basin head eastward to Asia. And the other thing going on is some of the other refiners, particularly countries that have decreasing domestic demand, are having to shut down a lot of the less sophisticated capacity. As you can see, Japan here, has a very strong refining consolidation going on, but also Taiwan, has over 200,000 barrels a day of capacity coming off, and Australia. And in addition to that, the question of Canadian product exports, this idea of eventually having a refinery in British Columbia that would be somewhat export oriented, that also could put additional pressure on that market. And coming back to the global crude oil flows, the Middle East share of crude trade, internationally traded crude, is set to increase only slightly. But Africa is, 21% of the market by 2018, as African production increases. And much more of that is going to be heading eastward than would have previously been assumed. You have much more of the Gulf and African crudes flowing eastward, and, that kind of is changing some of the, also political alignments and diplomatic contacts. It's interesting that, Nigeria even, which you used to think of as a supplier into the U.S. East Coast and Gulf Coast primarily, their biggest importer in April was India, which I never would have thought of as recently as a couple of years ago that would be the case. And this is just showing the Brent Dubai spread. And China is building out a lot of capacity for heavier barrels. I won't go through all the numbers here, but they're increasing their domestic refining capacity and the sophistication of it, but in ways that were planned out before the magnitude of the shale boom was really completely understood. And it may continue to surprise on the upside. The new tax regulations that came into effect at the beginning of this year are hurting the profitability of the teapot refiners, and we do see a trend in China toward the gradual phase out of the teapot refiners. Part of that is also going to be driven by tightening environmental specifications. They're not going to get up to Euro 4 and Euro 5 by the dates that they've announced for that, but they're moving in that direction, and that's going to help to kill off the teapot refiners. And the Russia-China deal, in light of that, desire for diversification, it reflects, Russia's, coming to grips with the fact that European demand is not coming back, and this outlook for that is pretty dismal, even if we have a modest economic recovery there. But it also reflects, a shift eastward, and a realization that they're gonna have to sell more to China, and also, the fact that the Chinese side was able to offer this loans for oil financing, which made that more attractive. But again, this feeds back into the theme of a relatively lighter and sweeter than the Middle East crude stream becoming an increasing part of Chinese supply. And lastly, I want to spend a little bit of time on LNG because that's important to Asia. Without going through a full primer on LNG, it's much less of a global market. There's not one price, but the key point here is that the pressure of U.S. LNG exports is beginning to have a bit of an impact on the relative negotiating positions of buyers and sellers in the global LNG market. We see three emerging dynamics that'll help to begin this shift. One is a surge in output of LNG globally, with the U.S. thrown into the mix there that will foster more gas-on-gas competition. There are a number of political risks at the country and regional level that could slow down or end some of the proposed projects, but we still see a market that is becoming better supplied when you get beyond 2015 and becoming a bit more of a buyer's market. And you also have very strong government support, in terms of diplomatic support for moving not away from oil-linked pricing, because that's still going to be necessary for projects, export projects outside the U.S., but moving toward essentially bending the S-curve in ways that mitigate some of the oil-linked pricing risks. U.S. LNG, it offers, essentially a negotiating leverage for some of the Asian buyers. You already have contracts in place for supplies, to South Korea, India. You're probably going to see, a good deal of that volume go to Asia, from the U.S. projects. We still think that the Obama administration, despite having issued the second project approval for Freeport, they're going to slow walk this and try to open the spigot on gas at a kind of gradual, measured pace. So we don't see a third project approval as being, as being a real speeding up of that process, or being imminent. But they're kind of gradually, trying to introduce U.S. LNG at in a way that will not impact domestic pricing and kind of walks a middle path between competing political pressures in the U.S. And it's interesting to note that, with the U.S. shale gas boom, Japanese companies have been active in the U.S. upstream for a long time. There have been a lot of headlines about Chinese acquisitions in the U.S., and that's becoming increasingly important. But as this table shows, there are also a lot of Indian parastatals that have been investing in the U.S. So there is this drive by the Asian importers, the largest of them, to get a toehold in the U.S. upstream and also acquire key technologies. And as I mentioned, the non-U.S. projects we still see as requiring oil-linked pricing, just under formulas that mitigate that risk a little bit. And coming from different places, Australia has been growing, but there are cost pressures there. But also East Africa with Mozambique and Tanzania, and the Eastern Mediterranean. Although some of the with Cyprus and Israel, some of the political issues are perhaps a little bit more daunting. And I won't go through all the countries on this because I don't have time to, but this just illustrates a lot of the regional and country level political complexity that can impact some of these projects. And so it becomes difficult to forecast this because there are so many different political variables that impact these unique cases. And over the longer term, the real one wild card is Chinese shale gas. The resources there are a lot of hurdles to development. I think that we are pretty skeptical of the 5-year plan target that they would really increase gas usage that rapidly. But the development of internal price reform and oil-linked pricing is probably a boost for shale development over the long term, but will also probably slow demand growth and keep them from achieving these targets. And the other big wild card for Asian LNG is Japan's desire to reduce reliance on nuclear power. I won't go through a full explanation of the U.S. approval process, but it makes a distinction between free trade agreement countries and non-free trade agreement countries, and this has become a big issue for Japan with the Trans-Pacific Partnership, because they would like to have the TPP become equivalent to FTA for approval purposes, so you don't need to go through that special process. I don't think we have a firm view how that is going to shake out. Probably less likely to be rolled into the TPP process. But the question of how much Japanese nuclear capacity comes back on is also a key determinant of how the LNG market evolves over the next several years. And with that, I will open for questions.
We have plenty of substance to talk about. I want to start with a broad question. As I listen to all of your presentations, I hear a host of different uncertainties, whether they're in Asia or the Middle East or in the United States. And so I'm curious to hear from each of you. Are the biggest uncertainties at home for the development of U.S. oil and gas and what's happening, or are the biggest uncertainties abroad?
Ladies first.
Oh, no, okay. I think it's a great question. I would say that given the sort of bottleneck political environment in the United States where it's hard to get the public engaged on any topic whatsoever, I would say that the greatest uncertainty is abroad, because even though there are these really big picture regulatory efforts and debates in communities, both state and federal, I think it's hard to pass things in the United States today, anything. And so, whereas some of the uncertainties abroad seem to be highly spontaneous, and therefore, and long-term structural. And so I would say that those uncertainties are probably greater than the sort of trend lines we've all talked about for the United States, which will be hard to change.
Charles.
Take a little bit of a contrarian view.
Okay,
Okay.
right.
Sitting at a meeting with Secretary Chu about a year ago at the Harvard Club in New York, and a bunch of investors sitting around the table. And they were talking about LNG terminals, and the concern that they had globally is making a choice about putting terminals in Nigeria or putting them in the United States. Where would be the next place? And these guys, to a person around the table, said that they have this big worry card about U.S. policy. And I looked at the guy and I said, are you telling me that the country risk in the United States is higher than Nigeria? And with a straight face, he said yes. Now, I don't know that I buy that completely, but that was a big data point for me, okay? And I think going back to what we were talking a little bit about here, it's something that the known, I don't know, geez, I don't want to get weird, but known knowns and known unknowns and all that kind of stuff. There are a lot of things that we know we need to deal with, but we're not doing it, and it creates the uncertainty.
I'll just note to my relief, I think Greg's chart said that the United States still has a low risk of piracy, so we can that's an easy one. Or maybe you guys are being a little too naive. Greg, what's your take on it?
I would say both. I mean, the scenario that I outlined for the OPEC producers, becomes very uncomfortable and unstable within a pretty short time frame. But also, when you think about U.S. policy and how much shale could grow in the future, there's still a lot of uncertainty around the upside that deals with state and local level political issues. The question of the Monterey Shale, will California politics ultimately inhibit that from ever being substantially developed? And really thinking out beyond 5 years, a lot of that comes to when you get into blue state shales and the potential political problems there in a better supplied market.
For any of you still on this issue, do you look at oil and at gas differently at all when you think about this balance?
Oh, God, I keep having to go first. I would say that I would answer that question in a slightly different way. What I would say is there's just so much gas that the possibility of risk asserting itself in gas is perhaps less impactful, barring an attack on Qatar LNG, right, as part of the Syrian war, than all the different things that could happen in oil. But now that Chuck has given his answer, I will say that the blocking of Keystone Pipeline for this long a period of time was really kind of stunning when you think about...
Unimaginable, isn't it?
Yeah, right. So I have to give pause to Chuck's comments and think that through, but I would say that the oil risk seems still higher to me than the gas risk.
Anyone else on this distinction?
Well, it's interesting. Several years ago, we were all sure we were running out of natural gas. Then we started to do some exploration. Then we fracked a little bit, and now we've got this incredible amount of natural gas. I would suggest that perhaps right around the corner from this, we may be 5 years from now talking about how much oil we have in this country, too. I mean, when you start talking about the residual oil zones in West Texas and some of the things that we're just now starting to learn with all the exploration technology, computational modeling, all the things that are coming out now that are basically making that question perhaps maybe one and the same with those products.
Seems to be a pretty simple answer with oil. Because unless, just with the supplies of gas, it's hard to think of any, might be a few regions that would have a risk equivalent to oil, but seems to me pretty cut and dried.
Amy, you said, you talked about the trend lines, particularly in the call on OPEC, and you said this doesn't look very different from the 1980s. Or this looks the same as no different from the 1980s. You see any differences from what that pattern was then? Is the fact that tight oil declines quickly change the picture? Are there factors that make this different from the 1980s?
Well, I think Mahmoud and Ken pointed out, and I have to defer to them to describe it, but I think monetary policy is different. So that's a difference. The other big difference that I see, though, you had the Clean Air Act on the refining sector, but the atmosphere about environmental regulation seems to be much more intense this time around than it was in the 1980s. And so I think that impacts the possibility of a price collapse in the sense that, you know, you've got these other factors coming in that raise costs through environmental regulation, opportunities through environmental regulation. You have a lot of sort of hanging around technologies that are too expensive on alternative energy that could, you know, have a breakthrough or get a sudden policy boost that's an unexpected policy boost. I say that now that I'm living in California. So I do think that atmosphere is very, very different, but that atmosphere could actually really accelerate demand destruction. So the funny thing about demand destruction, you know, having watched it now 3 cycles, not to date myself, is that it's very tipping point. It seems like there's no demand destruction, and then demand is like totally gone, right? And I have this sort of just intuitive, visceral feeling that the demand I can list so many things that are demand destruction, whether it's, you know, NGLs leaving the United States to go to China, or the petrochemical industry moving here, and so therefore China won't need naphtha, whether it's you know, the long-term path for car technology here and also in Europe, whether it's the fact that we can't get back on a pretty strong growth path, and so therefore you're not going to have this support from economic growth, whether it's natural gas staying cheap, and so therefore it's going to knock oil out of other different functions and not necessarily just coal. Natural gas and transportation might be slow, but could happen, right? So if you add all those things together, I just think that there's going to be this tipping point where someone's going to wake up in a hedge fund and they're going to have a demand destruction story. They're going to go short, and then everybody else is going to leap on top of it, right? And that seems like it could be a much more compelling story than the China demand story, where you really need to have a tremendous amount of visible China demand to keep that story going in the face of all this other demand destruction.
Well, just to kind of build on that a little bit, I do believe the biggest single difference between the 1980s and today is how many darn cars there are in China, okay? And it's a completely different world we live in, and our United States vision of the fact that we're the global leaders and trendsetters in demand and this and that and the other thing, I got to tell you, those days are over, I believe, and they're going south fast in some ways, and I think that's the single biggest difference in my mind.
But there was a Japan demand story in the 80s that didn't pan out. And
yeah, but there's not a 1.4 billion people in Japan, right?
That's true. Yeah, there's definitely a population difference, right? There's definitely a huge population difference. But there was this. There are these demand stories, and you know, and I understand. You know, we've done forecasts here, and Ken can throw up those slides about the pathway for fuel for cars in China, and it's a big line, right? But the actual historical line in China has been things like diesel generation to boost industry and other kinds of oil use that was not from the actual car story, right? And also, you know, I'm about to go to Beijing to have some big giant seminar on LNG trucking in China, right? And I'm not saying that that's going to eliminate all of their oil demand, but again, I could come up with some substitution stories.
You know what they're doing with license plates now in Beijing? I mean, it's every other day you can
Right.
drive. So now everybody in
Right.
China has 2 cars with an even and an odd
Right,
license
right,
plate,
right,
so
right,
they
right.
can go downtown, right?
But people who take the.
Let me ask
ahead.
about this, because this is an interesting space. When people have been putting up various charts that look at how non-OPEC and OPEC supplies fit together and whether OPEC countries will have to cut back. But I haven't actually heard a lot in these presentations about uncertainty on the demand side, which really does tell you whether everyone can fit in a larger pie or whether there are these stark trade-offs that can have these nonlinear consequences. Should we be talking more in this whole conversation about the global consequences of U.S. oil supply growth? Should we be talking more about that demand uncertainty? And Greg, you put up the IEA numbers. How much should we believe that?
I personally would be a little bit more bearish than that in the out years. And part of that is, and it's hard to model this, but there are, when you think about China's motorization growth, and you look at the traffic congestion in major Chinese cities, and then you see the beginnings of these public policy things, like the odd even license plate numbers in Beijing, like talk of congestion charges, things that they're doing with land use policies that discourage construction of houses with large yards, even for people who can afford them. And perhaps it's easier to do things like that in a non-democratic country where you don't have to listen to the voters. But it seems obvious to me that you couldn't have the same level of motorization as China's GDP grows as you've had in the U.S. And as they build out these new interior cities, the next 5-year plan is really focused on trying to move economic activity away from the coast inland, that they probably end up building these on public policies that will look a bit more to the Tokyo end of the spectrum and less to the Houston end of the spectrum, because they simply can't do that.
Greg, you made this comment about the United States becoming more energy self-sufficient and China having big remaining geopolitical vulnerabilities. And so there was a clear contrast in that. What do you see are the U.S. geopolitical vulnerabilities that have been meaningfully reduced by the trend in U.S. oil production? There seems to be an underlying assumption that there has been something that's changed commensurately in the United States that hasn't in China.
Well, I don't think it insulates us from prices. I mean, clearly, if you had a big disruption event in the Gulf, it's a fungible commodity. So we're still part of that market that's potentially unstable. But we are getting to a level where even in some of those worst case disruption events, if you think about what would happen with like hemispheric price spreads in the short term, if something happened in the Gulf, I'm not sure that those would react the way that they did before, partially because of the perceived short-term nature of those disruptions. So it's fungible, but in a short, sharp shock like a Strait of Hormuz crisis, I think people would be surprised at how much some of those regional disparities would widen out.
You put any numbers on that?
I'd be reluctant to. But I'd be reluctant to.
Does anyone else want to speak to that? Because that seems to be, at least implicitly, part of the underlying discussion when people say we will be considerably more energy secure. We weren't worried 3 years ago that someone would blockade our coasts. So that's not what we're becoming more secure against. So what is it that when we say that we're gaining this greater security of energy supply, what is it that we're talking about? Does anyone else want to weigh in?
So I tend to articulate it in a totally different way that not everybody agrees with, but I see it as revenue inflow, outflow. So in other words, oil prices go up, and as Greg points out, that affects us too, but then people in Pennsylvania are going to get that cash flow, and not people in Saudi Arabia and Russia, right, to some extent. And to the extent that the cash flow achievement of the higher oil price. I say that easily, like sitting from having just lived the last 25 years in Houston, right, where a oil price surge, has always been positive for the Texas economy, and the U.S. overall, not so much, right? But as there are more and more states that look like a Texas, when Pennsylvania, Ohio, Arkansas, and so forth, when it's, instead of it having be 5 or 6 states, when it's 12 states or 15 states that are going to get this economic boost, then the picture is going to be much more mixed for how it affects the United States economy versus the global economy. And I'm not saying we're an isolated island, and if we can't sell things to China or we can't sell things to Europe, that's going to be a lot more material on our economy than just that some people in Pennsylvania have higher revenue. But it's an ameliorating factor.
If I told you there was a gasoline station down the street 2 blocks from here and it was selling gas at $2.25, you'd probably get up and leave right now.
I live in New York. I haven't thought about buying gasoline
Well,
in years.
yeah. I mean, but think of that. 20 years ago, if you'd have told me gasoline was $2.25, I'd have said, you got to be kidding me. And so I think you get readjusted. People get readjusted over time. And I think it's funny, every time prices spike up, and then a month later, they kind of walk their way back down again. People get less hysterical, and it's just sort of moving that needle up over time. I don't know that people haven't gotten used to $3 gasoline now, and they're just glad it's not $4. But that'll change over time, too. So.
Well, and the question is, did you actually, though, change your permanent habits? Would you go to a restaurant to go out to dinner that's an hour from your house now versus 5 years from now? I think that's why I put up the chart of the VMT line, right? Because how people think about their errands, how people think about their lifestyle is much less, I think over time is going to become less car-oriented, right? And so therefore, especially if the Chinese come in and try to suppress that culturally, and then we're suppressing it culturally just on a social basis and not through policy, that these giant straight lines up are just not going to be giant straight lines up. Even though the car companies will sell all those vehicles, it's how will people use them?
So, even today, though, people are still sitting at Starbucks for 15 minutes, idling their car, waiting for their takeout coffee that they didn't go in to get, because they're still burning relatively cheap oil. I mean, if you think about what our gas costs compared to the rest of the world, I mean, we're in a wonderful world here in the United States, and people's behaviors take a while to change.
I think one thing we've established fairly clearly is, even though we're talking about all these different supply trends, we have big fundamental disagreements over the demand side that have consequences for that. Let's talk a bit about LNG. Amy, you said 100% spot pricing in Asia. Greg, you said others won't do that. They'll tweak the S-curve, but they still need oil-linked pricing as a sort of underlying fundamental in order to finance these projects. So talk about why each other's wrong. Ken said a draw of disagreements.
Okay. You want to go first?
But yeah, I'll lead off here. I mean, part of it is there are a lot of, we don't think all of those countries are going to build out new supply, so it's not quite as well supplied a market as that implies. The labor costs in Australia are starting to have a big impact there. I think that it's an evolution toward that, and it may eventually get to all spot pricing over the very long term, but we just don't see it. Partially this is talking to people on the buyer side about their strategies, and they don't really expect it to get there soon. But out beyond 3 to 5 years, it might. Just a longer time horizon.
And what would it take? You had 3 bullet points. One of them was evolution of hubs in Asia, and that you didn't get to that bullet point. Is that part of the answer?
Well, that you would need some sort of regional tradable contract that would be a proxy for that, and that's a very it was a brief presentation, but if I'd had more time, our view is that develops over a 5 year plus time horizon. It probably eventually gets there, but we just don't get to see it getting there quickly.
Amy?
So I would say that Greg and I actually don't disagree in terms of the timeline. I mean, I think it'll take a long time, but some people don't believe we'd ever get there. And so maybe Greg and I are not so much in disagreement, but for the people who don't think it would ever get there, I tend to use this analogy of heavy crude refining, in the Gulf Coast and other locations. So it used to be that when Pascagoula, for example, refinery was first built in the United States, it was built to have a dedicated stream of this heavy crude from Saudi Arabia. And it was especially heavy crude, and you had to have special units to refine it. And, you know, and even in China, you know, they went out and did this special deal with Saudi Aramco. They weren't going to put in that unit unless they had this special crude oil supply deal, right? And you had a facilities-based end user thing that would cost billions of dollars and billions of dollars in a heavy crude field, and it looked like, therefore, you'd never have a financialization of oil, and that oil would not be fungible. And we all know the end of the story. And I guess my view is really colored. I tell people that the year you come into the oil industry makes you who you are in the oil industry. So I came into the oil industry in 1983 to be the first person to write about the crude oil contract for Wall Street Journal Dow Jones a couple months after it opened. So I came into the market in a price collapse, and I had millions of people from the oil industry explain to me that posted prices for domestic crude would never, ever become NYMEX related. Right? And I was this fashionable person from New York coming down, talking to you about the NYMEX, and everybody here, explained to me why the posted price system would never be changed. And it only took a year. Right? So I agree it's going to take longer in natural gas, but I've heard that story before, and that's why I don't really believe in that story.
Let me say something about natural gas, and this may be well known to everybody, but I think it's kind of interesting. It's the same way people talk about crude and coal like it's one big commodity. And gas isn't gas. If you think about it, 7, 8 years ago, we were planning on importing natural gas from facilities all around the world. And the heating value of that natural gas is something like $1,200. That's the way it is around the world because they're full of liquids and everything else. We're stripping out all of our liquids in this country. The reason we're doing what we're doing in the Marcellus is to get the liquids. And our heating value in this country is always $1,000. So you're not just going to flip a switch, just liquefy it, send it somewhere, and try to put it in burners that are set up for 1,200 BTUs. It's just not going to work. And so, you know, we kind of get ahead of ourselves sometimes. You think about all the technical issues associated with just jumping into the gas market long term for LNG export.
We're almost out of time, but I want to ask all of you the same question. What's the biggest uncertainty in what we're talking about 5 years from now that hasn't been mentioned so far? Greg, you first.
I think with energy, you always have to go back to technology change, because so many of these things, you know, if there were a breakthrough on energy density of batteries, let's say, you know, I would have a relatively bearish view right now of EVs, partially based on the fact that, you know, consumers don't see fuel prices as being that problematic right now and probably coming down a bit. But there's always the possibility that even if investment falls off in some of these things, that there will be a disruptive technology that nobody foresees right now.
Charles?
I'd say it's technology and the threat of war.
And technology broadly, or in any particular area?
I think it's technology breakthroughs and the ability to find more oil more effectively. Yeah.
Amy?
So I'm going to try to mention something we haven't mentioned at all, so which is specifically U.S. focused, but could be other focuses too. And that there are two things that kind of somewhat go hand in hand, but could be separate. One is unbelievably severe weather events, because you could have an unbelievable severe weather event that would knock out facilities in the Gulf Coast or some other place. And just as we saw in Japan with Fukushima, right, it can dramatically change everything we've just talked about overnight. So that would be one. The second one, which is somewhat related to that, is a giant accident, right? So it turned out the Macondo did not stop drilling in the United States in a long-term way, right? But it's unclear to me whether there could be some kind of accident that would really change people's perception about a particular fuel or a particular technology in a way that, again, could be highly material.
A lot of different things to think about on top of everything we've discussed in the last hour and a half. Thank you all for your comments, and thank you, everyone. I think Ken has a few words before we the lead pen that's going to stop you from getting to your drinks.
No, I'm not. Thank you all for persevering. It's a fantastic way to end today, so thank you, panelists, and thank you, Michael, for running the show. There's a lot to chew on. Hopefully you all learned a little bit and we provoked some internal thinking. Those are always the best sort of takeaways when you can walk away and have to think about something a little bit more, because at the end of the day, it increases the engagement between us and you all. So that's really important to me, and I know to everybody else up here on the panel. So again, thank you. And now we'll just kick the doors open and go enjoy ourselves.